borrow money. Interest rates are still pretty low right now, so if you own a home, you might have an opportunity. Most people have the goal to pay off their house as soon as they can. This is a respectable goal, especially if your interest rate is pretty high. So what I'm saying is probably a little different than most people are used to hearing. I'm saying it could potentially be advantageous for you to actually borrow more money instead of paying off your loan sooner. You can lock in a 30-year fixed mortgage at a low interest rate. You might think this is bad because you'd be wasting money on that interest you're paying, right? But you could invest the money that's given to you. Let's say you borrow at 4% interest rate. You can invest and get 7 to 10%. Here's an example. Let's say you get a cash out loan of $100,000 based on the equity of your house. At today's interest rates, let's say you'd have to pay back the lender $5,000 every year until the end of the term. You can take that $100,000 that was given to you and you can put it in an S&P 500 index fund and potentially get about $7,000 to $10,000 every year. You could profit something like $1,000 to $4,000 every year. And this may not sound like much, but this is all from borrowed money. This is the bank's money. Also, even if you are breaking even from your investment income and your loan payment, you'd still be paying off that principal. So at the end of the term, that $100,000 would be yours. Also, the interest rate that you're borrowing at is not adjusting for inflation. So this $5,000, let's say you'd have to pay each year, becomes less and less important as time goes on. And let's say you can get about 7% in the S&P 500 index fund. That's adjusting for inflation and that's compounded. So to make this comparison a little bit more fair, let's not inflation adjust your investment. That 7% is maybe more like 10%. So you can borrow at 4% and make 10%. Here's another way to look at it. Let's say somebody gave you $1 billion, right? And they said you have to pay them back $58 million every year for 30 years. You can take that $1 billion and invest it. And let's say that generates $58 million a year. You'd be breaking even. The amount you'd be making from your investment would all go to your lender each year, right? So that doesn't sound like you're helping yourself out, right? But at the end of that term, you would keep that $1 billion. That would be all yours. And even when you pay it halfway, when you pay half of the loan, you'd have $500 million. So it's easier to think when you look at numbers like big numbers like that. You can do it kind of at any amount if you have equity in your house. And there's probably a good chance that the value of your home went up recently. But here's a little caveat. I think now can be a good time to borrow money, but now is maybe not the best time to invest. So what do you do about that? I would say you could still borrow money at a fixed rate for 30 years and you just sit on it. Now I know that sounds bad and you'd have to be paying that loan payment each month, but you were just given money, right, from the bank. This is the bank's money you're using. You wouldn't really have to take it out of your money. It's the kind of the bank's money. So you can take this money and sit on it and wait until maybe the stock prices become a little bit more reasonable. Now that's a little bit hard. This is usually actually really hard to accurately predict if there's a stock market crash or something like that. But I think stock prices are very high right now. Even if you had to wait 5 years to start investing that money, it could still work out. You would just be taking a chunk out of your borrowed money. You could have a 30-year loan in the first maybe 2 years, maybe 5 years. You could pay back the loan by taking it out of the borrowed money. And then once the market conditions are a little bit better, you just dump it in an S&P 500 index fund, and then that covers it. Still, another thing is this would be a paper growth in the S&P 500 index, and you would have to also pay taxes on the profit that you made from that investment only once you sell. While your investment is growing, you would have to pay out of your pocket from the money you have from your job or something. You'd have to be able to cover that monthly payment. So you don't want to be too aggressive with this. There is a little bit of risk doing this, but there's a good amount of opportunity.
If you're going to sell your house, you could pay capital gains taxes. But if you get a loan, you don't have to pay any taxes. But at the same time, you can write off all of the interest you pay on your loan, up to $750,000. And at the beginning of your loan, you're mostly paying interest anyway. The amount you actually save would be based on your tax bracket.
You can look back and see that there are market cycles. There are bull markets and bear markets. And I think stock prices and real estate prices are pretty high right now based on a few different metrics. The Shiller PE, the Buffett indicator, and also inflation is going up, and usually the Fed has to raise interest rates. And usually when that happens, it brings down asset prices. So I am thinking stock prices and real estate prices will become a little bit more reasonable in the near future. It's hard to say exactly when, but I feel like it's in the next couple of years or so. If you're going to do something like this, you should consider a bad scenario and see if it still works. You should do the calculations to see if it would work out, even if you had to wait, say, 5 years for the stock prices to become more reasonable.
So you go to the bank and ask them for $100,000 based on the equity of your house and agree to pay them back with 4% interest. You could take that money and invest it right away, but I'm thinking stock prices are pretty high. So let's just say you had to wait 5 years for better stock prices. At about $5,800 a year, you'd have taken a $30,000 chunk out of that loan. Then you're left with $70,000 and you invest that at 10% for the remaining 25 years. You could invest it passively in an S&P 500 index fund, or you can put it in a rental property, either buying it cash or with more leverage if you want to optimize cash flow. You could net over $475,000 at the end of the loan after considering all of your loan payments and your capital gains taxed at the maximum 20% rate. That's an average of about $15,000 a year across the entire 30 years. This isn't even considering the amount you'd be saving by writing off the mortgage interest on your taxes, which can also be invested and compounded. If you only had to wait 2 years for better stock prices, which I think is a more likely scenario, you could net over $865,000. That's $28,000 a year on average. Now, this is where it gets interesting. Instead of investing the money passively in an S&P 500 index fund, you can invest the loan in rental properties. This does require more work, but it can be good if you want to optimize for cash flow. So you can take a cash out loan of $100,000 and buy a rental property cash, or you can use it as a down payment to purchase multiple rental properties. You could buy 4 $75,000 houses, putting $20,000 down on each. Then you can borrow the remaining $220,000, and this is in addition to your $100,000 cash out loan. So really, you're borrowing about $320,000. Then you could cash flow about $10,000 a year. This doesn't sound that great, but this is in addition to any capital appreciation, the equity you're building up from the principal payments, the mortgage interest you're writing off on your taxes, and you could be profitable on year 1 without having to pull any money that you earned from your job. The purchase of the 4 houses could all be covered by your original $100,000 cash out loan. And if you reinvest the cash flow from your rental properties, after 30 years, you could net about $1.9 million. And again, this is after you paid back the lender all of the money.
So this is a way to make money off of other people's money. So I know I just said a lot of things. If some of that was confusing, or if you have questions or something, let me know. I like talking about this stuff. Anyway, that's all for today.